This is Chip Maxwell, and you're listening to the Retire Smart podcast with David Brooks. Today, David Brooks discusses the upcoming State of the Market event, featuring insights on market trends and projections with a special appearance by financial expert Jeff Bush. David also gives insight on pivotal government economic movements and policies that have already taken place or are yet to happen. Well, David, the times and dates are set, and we can start inviting the general public for some limited seating for the annual State of the Market address. Of course, there's a federal State of the Union address every year, and this is kind of our parallel event, State of the Market. This is you doing what I call a tour de force presentation of the year that was and the year to come, packed with charts, graphs, data, analysis. And, David, you've upped the ante this year. Jeff Bush is going to join you, nationally known financial commentator Jeff Bush. How did that come about? Tell the folks about Jeff Bush.
Well, a lot of people are worried about this is a big transition, right? We have the pendulum swung pretty far this past election. So Jeb Bush is a nonpartisan guy out of D.C. who kind of has his finger on the pulse of what's going on. So we've invited him out to just speak on the likelihood of what policies will really get enacted based on, we have campaign promises and we're going to have reality, right? And how the makeup of Congress is, et cetera, and the likelihood of things being enacted, at least that were pushed on the campaign trail. And then I'm going to talk about what the reality of that is, after Jeff is done at this presentation exactly, and talking about what we see ahead for the economy and potentially for the markets.
Friday, February 21st, we're going to offer two sessions, 10 a.m. and 1 p.m. This is at the Durham Museum. If you come, you can also tour the museum for free. Now, clients, of course, are invited, and we are for the first time inviting the general public, but seating is limited. So you'll want to jump on this if you want to join us. 402-369-7777. 402-369-7777 to join us for the State of the Market address. All right, David, into the news we go. Here is the first headline. This is from CNBC. Budget deficit rose in December and is now 40% higher than it was a year ago. And you sent one of your little taglines. Oh, that's weird. You mean you can't just spend at will?
So for the fourth quarter or for the first quarter of the fiscal year. So our fiscal year starts in September every year, right? In October, the fourth quarter of the year is when our fiscal year is a
so the end of the calendar year is the beginning of the fiscal year.
Correct. And for that first quarter of our fiscal year, we overspent this year by $710 billion more than just a year ago. If you go back 25 years ago, that was the budget, right? It was the whole budget. And we spent more, Chip, on interest payments in the last 12 months than we did on defense spend, or the only things bigger than that were defense spending, Social Security, and Medicare, right? And those will get eclipsed very quickly. Defense spending is going to be less than interest payments this fiscal year, and in 3 years, interest payments, the way we're going, will be the number one expense of our budget. This is unsustainable.
Well, it's already north of $1 trillion a year now, right? The interest payment on the debt, and that was supposed to come in a year or two, and we've already surged beyond that. So.
Yeah, and so we've seen the Federal Reserve trying to get the markets to take interest rates down, but all they can do is control short-term rates. They can't control the real rates of the market. And when I say the real rates, the 10-year Treasury is the most common one we want to watch because that's a barometer of what's going on. That affects mortgage payments, car loans, credit card rates, right? Because this is what banks are buying to backstop any obligations they have. And so the mortgage industry is in crisis mode right now simply because, a 30-year mortgage as of this morning was 7.36%. Now, some people are like, oh my gosh, I talk about it all the time. That's actually less than the 50-year average. I still remember refinancing at 7.5% the first time I did a refinance on our first home many, many, many years ago, and we were thrilled with that rate. But the reality is with prices of houses, the median house closing a $400,000 range, that payment makes a mortgage payment about $3,000 a month and that's not sustainable for the average American. So we do see a major correction coming in not only housing, but in our economy in general, because the bond market is telling you, Chip, listen, inflation is being sticky. We just had PPI and CPI come out this week, right? It shows inflation is still there. It's not under control. And then the bond market is really pushing rates higher because they're saying we're not going to take on more debt or you're going to have to pay us a higher rate for it. On top of that, I know I didn't send you the link here, but China has a $1.1 trillion trade surplus with the U.S. It's over $1 trillion now. In other words, we buy way more of their stuff than they buy of ours, right? But we know we get goods and services really cheap from China. People like paying less expensive for things. The problem is they used to take a percentage of that profits and buy our treasuries. They don't buy our treasuries anymore. I don't know if you realize this. China has been dumping treasuries for the last 24 months, is a net seller of treasuries, is not purchasing, and they're buying their own, which is driving their rates down. This is going to lead to a very major problem if our 10-year crosses over 5%, and we're not that far away now.
Well, since you brought up the topic of interest rates, David, let's jump to you sent me a story. This is also a CNBC headline. The Fed could be done cutting rates if Trump's tariffs are imminent. That's according to research and study by Bank of America. What is the relationship between tariffs and interest rates?
Well, unfortunately, you have, depending on where someone got schooled, these Keynesian economists that believe tariffs are inflationary, and there's zero data anywhere in the world to prove that's true. In fact, just the opposite happens. However, the meantime reaction is prices will adjust, but it is not actually inflationary on the production of the goods or services. It creates a balance. Now, this was written and before we had PPI and CPI, and the futures market only had about a 6% chance of a rate hike in 2025. Remember, we were talking about 7 cuts last year, or a rate cut, only 6%. After PPI and CPI, we have about a 40% chance we're going to get 1 rate cut here in 2025. In other words, if inflation is under control, they might have room to bring it down. They are desperate to get rates down, as we said, because we have to refinance $7.6 trillion of already existing debt and another $2 trillion of new debt. So we're gonna float out over $9.5 trillion of bonds this year as a government, and we don't want to do it at 4.5% or 5%, right? And Janet Yellen did zero favors to the incoming administration by not following the normal curve of 2 years, 5 years, 10 years, 20 years, 30 years, et cetera. She refinanced everything on T-bills for the last 24 months, and that's what's created this massive problem. So again, this is going to create some problems. Now, creatively, what Trump's administration has already leaked out in the last 48 hours is they're going to do their tariffs in stages. In other words, instead of a 10% tariff on a country, 2%, get in line. Next month you didn't get in line. Now it's 4%, and they're going to walk the tariffs up gradually to actually
gradations. There'll be tiers of tariffs.
So, which is actually really smart because it will lower the rough edge, if you will, or the shock and awe of having a tariff placed on certain people, and it will give countries the opportunity to get in line or suggest something that gets it done. Bottom line, he's already got people coming to the table, fighting to get to his inauguration, which Josh Cheadle, our director of advisory services, going to be attending the inauguration. I was blessed to be invited, but due to other circumstances, I can't attend. But his daughter will be singing, by the way, so we need to get Josh on the show here to talk about that. His daughter will be singing at the inauguration, so we're really excited for that. But anyway, it's we can't keep spending. It's just obvious, and the bond market is telling you that, regardless of the euphoria in the stock market after the CPI number this past week.
I like that Keynesian reference, John Maynard Keynes, the famous economist. How many other advisors? I don't
famous
know.
wrong economist.
Well, exactly. I mean, he's considered gospel by some, but we've got to call him out now and then and point out that his doctrines are flawed. You mentioned Janet Yellen, and I know she's a short timer, and I don't want to pile on, but you did send me this, David. This is a headline from, this is also CNBC. Janet Yellen, COVID stimulus may have contributed a little bit to inflation. You think so? I also want to get your take. The story mentions her successor appears to be Scott Bessent, Trump's choice for Treasury Secretary. Your take on him?
So he's a billionaire in his own right. He worked for George Soros, but he worked for a couple other pretty big shops, and very, very well versed, understands economics, understands what moves the needle. He really understands the currency. That's what's really important here. He understands how the dollar is going to react based on the different policies that they may put in place, and that is why Trump chose him. And we have a very strong dollar right now. Once they kind of get in place in the tariffs, they're going to want a weaker dollar because that's going to help push our exports out, and that will help the economy here local. That'll help companies that export goods and services. So anyway, I'm positive on the choice. And again, this administration is making outside the box choices across the board of his cabinet, et cetera. And I always coach that coaches me. He says, always give people the benefit of the doubt. I will give the benefit of the doubt to someone that maybe don't have the skill set that you would think they would need taking some of these positions. But I think most Americans are fed up with the status quo. And so maybe new outside the box thinking is exactly what we need in some of these key cabinet choices.
Just quickly, one more story in this segment, David. And speaking of piling on, I don't know, maybe I get flagged for unsportsmanlike conduct for this, but we have to get the facts right, okay? The headline from Zero Hedge, now it's a little bit of hyperbole here. This is referring to job numbers, not everything on the planet. But the headline is, Biden lied about everything.
You don't say.
Philly Fed finds all jobs, quote unquote, created in the second quarter were fake. We got to be able to trust the numbers coming out of our government agencies. They can't keep coming back, 2 months, 4 months, 6 months later and revising. Oh, never mind. Those weren't the true numbers after all.
Over 1 million jobs last year. We didn't create a single job last year. Not one job was actually created. 1,086,000 full-time jobs were lost. We did create about 300,000 part-time jobs. And if you go back for the last 5 years, Chip, we have not created one full-time new American-born worker full-time job in this country. Not one. We're negative on American-born workers creating full-time jobs. And that's coming to, it's coming home to roost, all these numbers. And it was political. I hate to say it, but we used to... we've had speakers come to our events, et cetera, tell us you got to trust the data. I don't think so, because now we can't, and that's really, it makes it hard to do what we do.
I want Trump to succeed again economically as president, but I want the numbers to be real. And if there's
I don't want him going the other way. Exactly. Let's just tell
serve
the truth.
Our clients too here at this retirement planning firm, and we need to know what the numbers are.
Telling the truth. What an amazing idea.
All right. Thank you for listening to the Retire Smart podcast with David Brooks. If you want to learn how to generate lifetime income, reduce your tax bill, and maintain your lifestyle in retirement, visit retiresmartpodcast.com. And make sure to subscribe to keep up with new episodes every week.